All right, so my name is Rajesh. I am a direct lender based in Los Angeles, and today we'll be looking at 1720 Cerritos Avenue in Long Beach. It's a 7-unit apartment building, and it's got a 7% cap rate, which is pretty good for the Los Angeles area. Let's take a look here. So purchase price is $2.1 million. And it's got 7 units. Let's see how many are vacant here. Does it say anything about vacancies? Let's go ahead and open this in a new tab, the OM, or offering memorandum. Seven units. Let's see vacancies. 2 units. This has 9 units. Oh, potential ADU. Oh, that's tricky. But yeah, this is, I doubt that's the actual rent. Oh, maybe it is actual rent. Oh, it's 16,893. Potential ADU, high-end remodel. So that looks like what the plan is to get the increase in rents from these buildings, as you need to do a high-end remodel. I'm just going to analyze it based on current values. So let's take a look here. 7 units, 0 vacancies. That's going to be 0. This doesn't really matter. Gross annual income. 205,716 divided by 12 months gives you $17,143 a month. $17,143 a month. But this OM, the offering memorandum, clearly says 16,893. So we're just going to go with the lower amount to be conservative. That's the way an underwriter would do it. Always the lower of the two, unless we can prove that the higher of the two is the actual amount. Property taxes are calculated at 1.25%. Landlord insurance is calculated at $1,100 per unit. Let's see what other expenses these guys have. Vacancy rates look like 3%. Expenses are 26%. Maintenance is $600 per unit. These are estimated, so they don't really mean anything. Landscaping's 100, property management's at 5%, utilities at 800. Laundry, garages, 17,143, because they're charging for the garages and they're charging for the laundry as well. So that does become 17,143. Okay. Property taxes, 642 for landlord insurance. Our net operating income is showing 10,503. So we go minus 10503 times 12 gives us $79,000, $80,000 in operating expenses. But they are saying total expenses are 53,000. Let's zoom in here. $53,968. So we got to get rid of approximately 20,000. So property management, 0. They said property maintenance is $600 per unit or $4,200 a year, divided by 12, $350 a month. So let's see what this is starting to look like now. 17143 minus 132339 times 12, 46,000. So now I'm $7,000 too short. Well, yeah. 47 to 54 is $7,000. I got to come up with $7,000. So let's say this is, let's say 900 for property management because that's at 5%, right? 17143 minus 12239 times 12. That's 57,000. So let's see, maybe 800. No, let's say 700. Minus 2,400. 55,000. That's about 1,000 more. So maybe 650. And 7143 minus 12589 times 12, 54,000. 54,000 within a few $100s. That's fine. And we're still at a 1.2 DSCR ratio. So this property, you're going to cash flow more. You're going to put down maybe $75,000 more on a bank loan, but you're going to get a bigger chunk of the down payment. The loan is going to be much smaller. You're going to be cash flowing about $500 more every month. And that's at a 7.5% interest rate. On a bank loan, normally, like when you go to Chase and you hit a 1.2 DSCR ratio, they're probably going to give you like 5.75, 5.8% interest rate. And now the DSCR ratio goes up, down payment stays the same. Your monthly payments also stay the same. So whether you go DSCR loan or bank loan, you end up paying roughly the same. Well, that's not actually true because in order to get this interest rate on a DSCR loan, you had to buy it down and it would cost you about 5 points. So you're actually going to have to pay about $100,000 more. Now, the benefit is you can actually get the seller to pay that for you. You can get the seller to pay your closing costs for you in the form of seller concessions. And a loan this size, you're looking at about maybe $40,000 in closing costs without any buy downs. But if you've got the seller to reduce the price by, let's say, $100,000 so that it's $2 million instead of $2.1 million, but you still paid $2.1 million and you said, hey, credit $100,000 at closing costs, now you're financing the cost of the buy down. But on this particular property, it does not make any sense to do so because the cash flow is so strong that you can go for a bank loan. I think the only time, in my personal opinion, after running this scenario and a couple others like it, is that it only really makes sense to do a DSCR loan and not a bank loan and not an agency loan is when it's not strong at cash flow. Because then you can make it cash flow at the expense of the seller, whereas something that's already cash flowing, you only have to, say that a better way. If something is not cash flowing, in order for it to cash flow, you need to put down a bigger down payment because that means a smaller loan amount. That's one way to do it. And that's what banks do. They require a net DSCR ratio, a DSCR ratio based on net operating income. This number right here, the 12,000, not the 17,000, but the 12,500 profit or operating profit per month. And they do that and then divide it by their monthly payments. And when that number equals 1.2 or higher, the net DSCR ratio equals 1.2 or higher, then they will give you their fantastic interest rate of 5.75 without any buy downs. But on a DSCR loan, we don't really care about that. All we care about is making sure that this gross DSCR rents, that means this number divided by these two numbers and this number combined should equal at least 1.0. In this case, this is 1.6 times bigger than the combination of the P&I, property taxes, and insurance payments combined. The PITI payments combined. So that's the benefit of DSCR loan. Now, look what happens here when you go interest only with a DSCR loan. Your net cash flow is $5,000 a month compared to $3,300 a month. Now, you might still be able to do interest only loans on a bank loan with a small balance loan, but they're going to come with a 5-year prepay penalty. On this DSCR loan, this particular number is with a 1-year prepay penalty. And that means if rates drop below 5.75% after a year of owning it, you're free to refinance on this one. On this one, no, not without paying a penalty of at least 5% on the first year, 4% after the second year, 3% after the third year, and that's assuming they've arranged the prepayment penalties in a declining fashion. Some of them just require 6 months prepayment penalties, and some of them require a flat 5 across the full 5 years. So those are the differences between the two types of loans. But from an underwriting standpoint, this is a good buy. I'm surprised it has not sold yet. There's probably some issues that we don't know about that they're not being forthcoming about on this property. So if you've got the down payment of $500,000, you should buy this building. Well, you should buy this building if you want an easy loan to approve. I got to put that disclaimer and caveat in there. This sounds like an easy to approve loan as a loan officer. Again, none of this is investment advice. So,